Hello, friends. Welcome back to Block Bytes. If you were tuned in the economic crisis we are currently going through, you indeed must have come across a term called yield curve inversion. I know I did, but I don't know what it means. So, in this video, Vicky, our crypto trading guru, who also has a keen eye for the macroeconomic sentiment, will explain in simple language the meaning of this term. I hope you like this content.
So today we'll be discussing bonds and yield curve. The main point of discussion is yield curve only, but to understand yield curve better, we'll have to know the basics of how a bond works. What are bond yields? Now, coming to bonds, we will see what is a bond basically. A bond is basically a fixed income instrument that represents a loan made by an investor to a borrower, typically government or even corporates. So what a bond does is, see, any government, be it Indian government or the US government, any governments across the world, they issue bonds to the public and generate money to use it for fueling the economy.
Right.
So what government basically does is they issue bonds, get the money from the borrowers. They pay an interest rate depending upon the period of the period mentioned in the bond. It could be 3 months. It could be a 3-month bond. That is, the bond matures after 3 months. It could be a 1-year bond. Bond matures after 1 year. So during that period, the government will pay an interest rate, which is called the bond yield.
Okay.
So this is a basic thing. The purpose of the bond is obviously to raise money, use it to fuel the economy, increase productivity, increase the GDP of the country.
Right.
So again, bonds can be of different type, and mostly it is government bond only. So it gives the government bonds definition here. Next, we will go to what are bond yields. So what happens is the government issues bonds and say A buys 1 lakh worth of a government bond with yield 5%. Let us assume it is for a period of 1 year. So during that period, if A buys at 1 lakh bond issued by the government, he'll be getting a monthly payment at an interest rate of 5%, which is basically 5,000. So every month he'll be getting an interest payment of 5,000, and when the bond matures, he'll be getting the principal of 1 lakh as well.
Is it a monthly payout?
No, it depends upon bond maturities actually. Okay. If it is a longer duration bond, say for example 10 years or 20 years, then the interest payment is made annually. Gotcha. For shorter term bonds, the interest payments are made on the monthly wise or quarterly wise.
Okay.
It will be mentioned in the bond. There are different types of bond. Right. So it will be mentioned in the bond, the amount of the period on which the interest payment will be made. It will be mentioned in the bond. Right. There are 3 bonds actually, short duration bonds. For those bonds, the interest payments will be made on a monthly basis.
Okay.
Fine, sir?
Yes. And I mean, needless to say, the shorter the duration, the smaller the interest rate. Is that
exactly? Okay? Exactly. This was going to come about.
Okay.
It's like if you have fixed deposits, the longer the duration, the more interest rate will be getting more interest rate on longer duration fixed deposits, like in a bank.
Got it.
The bonds also longer duration obviously get more yield, comes up with a better yield, the higher yield.
Right.
You'll be seeing that actually as we go along. We'll be seeing that actually.
Okay.
Now this is the ideal scenario what I'm speaking.
Right.
Someone like B comes in. He also wants the government bond because it's a very safe instrument. It's a very safe instrument, and B can buy that government bond from A in the secondary market.
Okay.
This is clear, right?
Yes. Yes.
Yes. Now before I go into the bond yields, what we should know is the basic relationship. I'll explain the relationship as we go along, but for now we should know that the bond yields and the price of a bond are inversely proportional. I have an inverse relationship. That is, when the bond price actually goes up, the bond yields come down. This is very important actually to understand the yield curve. I'll explain why the bond when the bond yields go, when the bond prices go up, the bond yields come down later. But for now, we have to know that the bond yields and the bond prices have an inverse relationship.
Oh, so the price of the bond also fluctuates over a period of time?
Exactly.
So that is okay. That is
exactly. Because the bonds also have their own demand and supply.
Oh, that of course. So that drives it. Okay.
Yeah, and the demand and supply. Apart from demand and supply, the hike in interest rates, other economic factors, and decision by the central banks influence the price of bonds and the yield as well.
I see.
So before you go into the yield curve, this relationship you have to understand that this has have an inverse relationship.
Gotcha.
And also you have to understand the economic cycle. The economic cycle is basically this. The government said, I'm only talking about the economic cycle from the context of bonds.
Mm-hmm.
The government issues the bonds, the public raises money from them, uses it to propel the economy. Productivity increases, as a result of which GDP increases. And when GDP and productivity increases, you obviously know that inflation is going to increase.
Okay.
And
could you repeat that? Okay, let's do that again.
Yeah. I'll say it again. I'll say it again. Yeah. Government issues bonds, gets money from them.
Correct.
The money goes into the infrastructure projects. Right. It can be anywhere basically. Go to infrastructure. Can go into any other thing. It's basically the expenditure the government is going to do.
Correct.
Income. Spending on fueling the economy.
Correct.
That will increase the productivity.
Correct. That is third thing. Yeah.
And it's GDP.
Correct.
Which is the ultimate goal for issuing bonds.
Okay. So
Fine, sir?
Yep. So the ultimate goal of issuing the bond is to obviously to invest that money into infrastructure projects, invest in the economy of the country so that the economy grows.
Exactly.
Gotcha.
Got no? Mm-hmm. Fine. So what happens next is very important. Once the GDP grows up, obviously the stock market, the markets are going to be very healthy and they're going to actually rise.
Correct.
This is also this is an ideal scenario.
Right.
Obviously, when the GDP increases, markets are also going to be healthy and then going to be a rise. There is no doubt in that. Now comes the trickier part. When the inflation increases as a result of GDP.
And do you mind explaining why the inflation increases?
The price of, as productivity increases,
right?
As productivity increases, people tend to spend a lot more.
Okay.
Right, sir? That is one thing. The second thing, if you look at it, money supply is what decides inflation. Right? If the government is not borrowing money from the public, that money is not going to come into the system. Right? Let's assume A will have the money in his account, in his savings bank account. If he's not buying the bond in this case, A is going to have the money in his account, right? It's not going to do anything. But A comes to the system. If it comes to the government, the government is what the government is going to do is inject it into the system. As a result of which, that money, whatever money is going into the system, will have its own multiplication factor. In simple, like if you want me to put it simply, we have to know that when productivity increases, people tend to spend a lot more because they'll be earning more.
Correct.
So obviously, the demand for products increases.
There you go. Yeah. So yeah,
increases, which increases the price of a product, and then inflation increases.
Gotcha. All right. Yeah, that makes sense.
Right. So because people have so much money, obviously they're going to buy different assets. That's why you can see the stock market appreciating. That's why you can see any asset appreciating. Any asset appreciating is because inflation.
Right.
Fine, sir?
Got it. Yes.
Yeah. So now that inflation is increased, in some cases, like in the US right now, where the inflation is too much actually, and they're finding it difficult to control, what the government does is it actually hikes the interest rate. There is something called as the central bank interest rate, which decides everything else. Every interest rate prevailing in a country. For example, if the RBI hikes in our India, if RBI hikes the repo rate, what happens to our fixed deposit rates? It increases. And if RBI cuts the interest rates, or fixed deposit or savings bank deposit interest rate comes down. This is a basic relationship.
Right.
So this is very important. When inflation is high, obviously to bring down inflation, the government will hike the interest rates. And when the interest rate is high, basically interest rate is like putting a brake on the economy. It is not actually good for the economy in the short term, but in the long term, it is definitely required, to contain inflation. That's why if you look at India, our CPI target that the RBI is supposed to maintain is actually 2%. Just 2% of inflation. Sorry, just 4% of inflation. I'm not sure about the numbers, sir. Right. I think it's 4% plus or minus 2%.
Okay.
Doesn't matter. Number doesn't matter. What we have to understand here is that the inflation cannot be way higher or way lower. It has to be in a healthy, it has to be in a healthy manner.
Right.
So this is the simplest goal of all governments or all central banks across the world, to maintain inflation at a healthier rate. So when the inflation peaks, obviously to bring it to the normal interest rate, government hikes the interest rate, thereby putting a brake on the economy, slowing it down. And when the economy say, for example, slowing down, the central banks, cuts the interest rate. The reason why they're cutting the interest rate is very simple. And the interest rate is cut, like we are putting a savings bank, like let's say I'm a savings bank account, and the interest rate, let's say 2% or 3%. When the central bank cuts the interest rates, what happens is my savings bank interest rate comes down actually. At the same time, those that are borrowing, their interest rates also will come down. For example, let's assume I'm planning to take a loan at a rate of 10%. If the central bank cuts the interest rate, it will come down to 8%, which incentivizes me or anyone else to take a loan because the interest rates are cheaper.
Right.
So at the same time, if I'm having a savings bank account, since the interest rate is cheaper, obviously I will take it out and put it into some other place where it can actually multiply my money. I could take that and put it into work. I can invest in a business. I can do something because interest rate. So the government, by cutting the interest rates, tries to indirectly bring in money to the system. And when the money is brought into the system, it obviously is good for the growth of the economy.
Right. Fine.
The converse is, when the economy is surging, the government will put its brakes, cut the interest rates, savings bank deposit rates increases. So people obviously are incentivized to save money and not spend. Taking loans also become costlier when the interest rates are hiked.
Correct.
So this is the basics of it. Fine. So this is the basics. Yeah. So this is how basically I've told you about the monetary policy, how it is done. So in the context of the bonds, the government will obviously hike the interest rates.
Correct.
To bring down to slow down the economy and bring inflation under control.
Right.
Up to this point, it is okay, no, sir?
Correct. Yes.
Yeah. So what happens next when the government hikes the interest rates? Like we saw the bond yields come down. Like we saw the interest rates came down. The bond yields also come down for the newly issued bonds. Let us assume the government has increased the hiked the interest rates, and as a result, new bonds. I'm not talking about old bonds. New
Right.
bonds issued in the market, they are issued at a yield of 6%.
Okay.
Okay. Now, what government does is, or now what the let's say, see, sir, you can see point number 3 here. The ideal scenario that I was talking about earlier, you can see here, sir. That is, A buys 1 lakh worth of a government bond with yield 5%, right?
Mm-hmm.
Now, B can buy the government bond from A in the secondary market.
Okay.
I think this is an ideal scenario.
Right.
The principle remains the same. The principle remains the same. That is the bond price. In this case, in ideal scenario, the bond B buys from the government bond from A at a price of 1 lakh and with the yield of 5%. So when he buys the bond, till the maturity of the bond, he will be receiving payment of 5,000 from the government.
Got it.
Noted, sir?
Yes.
Now, second point, the central bank hikes the interest rate.
Correct.
As I said, the government bond yields increase. Let us assume it increases to 6%. These are newly issued bonds. So now comes C. Now C can do two things. One is that it can buy newly issued bonds at a yield of 6%. He can spend 1 lakh, buy freshly issued bond and get paid an interest rate of 6,000 every month. Fine, sir? Or he can do one thing. You can buy the bond from B. Now, let's say I am B. I am having a government bond right now with me that I spent 1 lakh rupees and I have a yield of 5%. I'm getting paid a monthly yield of 5,000. That is monthly interest payment of 5,000.
Yeah.
I will be actually, sad. Why? Because the new bonds that are coming out of the market have a yield of 6%, whereas I am having a bond that pays only 5%. Right? So this is a problem. When the interest rates are hiked actually by the central banks, those that are holding the bonds will actually suffer. Correct. Because whatever bonds they're holding, they bought it for a lesser yield. Right. And now there are issued bonds in the market for a higher yield.
Yeah.
Now comes C. C, like we discussed, C can buy freshly issued bond, or C can buy the bond from B in the secondary market for a lesser price of 83,333.
Got it.
Now, why he is buying it for a lower price? Because C needs 6% of interest rate.
Correct.
But if he buys the bond from B for, say, 1 lakh, he will be getting a monthly payment of 5,000, which means he's only getting 5% interest rate. So what he does is, in fact, he says, okay, you give me the bond, but I'll pay you less. I'll pay you less. Why I'll pay you less? Because only if I pay you 83,333, I will be getting 5,000, which is 6% basically.
Correct.
Now, who's the loser here? B is the loser here.
Yeah, correct.
Why? Because B sells it to A at a price that is lower than what he bought actually.
Right.
This is very important to understand the bond market. Why? Because whoever is buying a bond, if he keeps it till maturity, he gets the entire amount. He gets 1 lakh. As for example, in this case, say B holds this bond till the date of maturity.
Right.
When the bond matures, he will get 1 lakh, the principal amount, he'll get 1 lakh back. But the problem is, for longer duration bonds, it becomes a problem. Right. And who holds longer duration bonds? These are the big financial institutions across the world and even governments.
Banks and other. Okay.
That is, if you understood this actually, you would know why the small banks crisis happened in the US during the beginning of this.
All that, yes. That makes sense.
What happened was, those banks are holding a lot of long-term duration bonds. Because of the hike in interest rates, the bond prices have come down. Since the bond prices had come down, they couldn't trade these bonds in the market. For example, let's assume a small bank is having let's say, for example, small bank had 10,000 crore worth of longer duration bonds. Because of the continuous hike in interest rates, the actual value of those bonds on paper, this is a notional loss only, because when it matures, they will get back the 10 crores, 10,000 crores. But on paper, these bonds are worth literally almost 50 to 60% only.
I see.
This will affect the bank balance sheet.
Correct.
Because, this will affect the bank balance sheet because they'll have to maintain certain collateral against their reserves with the central bank. Apart from that, they cannot use these, since they cannot trade these bonds, because once they sell it, they would have sold it, the notional loss becomes a real loss.
Correct.
B sells it to C, it's done, that's all. He gets only 83,333, it's done.
Correct.
He's facing a loss around 16,000 plus.
Correct.
So what the small banks were facing problem was they were not able to trade these bonds. As a result, they were not able to generate money for lending purposes. Because once they trade, they'll be facing a loss.
Right.
So this created a problem in the US. This in fact triggered the small bank crisis. Now, since you have seen this, we have to understand that Seer actually gets the bond for a lesser amount at a price of 80,333. Now, what we could see here, when the central bank hikes the interest rate, the bond price has come down.
Right.
And the yield has gone up.
Right. This is the inverse relationship here.
This is the inverse relationship I was talking about.
Right. So the rate hike.
Simple example. I've given a very simple example.
Price reduction.
Bond prices actually fluctuate due to different reasons also.
Yeah. Okay. All right.
But if you understood
demand
this,
and supply, as you said before,
yeah. So if you understood this, what I'm going to explain further, it will make sense. It will make sense.
Okay.
Okay. We'll go to yield curves. This is the yield curve actually. Yield curve is nothing but it plots the yield on the y-axis and the time to maturity on the x-axis.
Got it.
So basically what it tells is, let's assume in this case, 5 years, the time to maturity in years, 5, 10, 15, 20, 25, 30, and the percentage it is given. Obviously, like we discussed before, for shorter duration bonds, the interest rate or the yield will be lower.
Right.
And as time proceeds, for longer duration bonds, interest rate will be higher. That's the normal yield curve. You could see the blue color.
Right.
Flat, normal blue color is what prevails in a very healthy economy, like India, for example. Okay. Now, there is a flat yield curve. Flat yield curve is just to, it's nowhere prevalent actually. It's just to show you the normal thing.
Right.
Now comes the inverted yield curve. Now we have to understand, sir, why the yield of longer duration, how can the yield of longer duration bond comes down? That is because when the central bank hikes the interest rate, what happens is, and we now already know that when the central bank hikes the interest rate, the yield percentage goes up and the bond prices come down. Now, what we have to understand is, in the yield curve, in yield curve inversion is that if the investors, not investors, if the institutions or whoever is buying the bond buyers think that the economy is not performing well, or the government is going to slow down the brakes. What they'll think is that recession may come. Basically, what they will be thinking is that the government is hiking the interest rates, which means it wants the economy to slow down. Which means they want the economy to slow down. Obviously, it will be pulling out of the stock markets, because stock markets are going to have a correction.
Correct.
Fine. When the government hikes interest rates, the general perception of investors or whoever is dealing with the financial markets, bond buyers, for example, Their perspective will be that since the government is hiking the interest rate, it wants the economy to slow down.
Right.
Since it wants to slow down the economy, people obviously pull out their money from the markets, from other markets, from the appreciating markets, like for example, stock markets, and then divert those money into safer instruments.
Like bonds.
There is no safer instrument than a government bond, obviously.
Okay.
So people, what do? They pull out money from the stock markets and settle in longer duration government bonds. And settle with longer duration government bonds. This, what happens because of this is the demand for longer duration bonds increases.
Makes sense. Yeah.
And when the demand for longer duration bond increases, the price of those bonds increases, which brings down the yield.
Right. Okay. That makes sense. Okay.
Makes sense. No? Basic demand supply.
Basic
When
demand supply kicks in.
There's a recession coming in the short term, I'll be pulling out from other markets and it'll be, what is it? Making that, ensuring that my money has to be safe. So they settle with government bonds. Because government bonds, nothing is going to happen. Government is going to give you assured returns. And the money is going to be safe. The government is not going to default. So what they do is they settle in longer duration government bonds. And when people think there's a recession coming, they'll obviously pull out from the markets and go to longer duration bonds. As a result of which, its demand for those bonds increases. There will be very few bonds in the market at the time. And because of that, the demand suddenly spikes because people are thinking recession is going to come.
Okay.
As a result, demand for bond increases, bond prices increase, and the inverse relationship makes the yield come lower.
Right.
Fine, sir?
Fine.
It has to be remembered that though the yield percentage comes down, they still be getting a fixed payment.
Okay.
Okay. I don't think that matters a lot. Okay. What matters is this, what I'm going to show next.
Right.
This is what usually economists do is they take two time periods and compare those, one shorter duration and longer duration. This is something that is like usually used.
Okay.
This is the 10-year, 3-month yield curve. Not yield curve exactly, yield spread. Fine, sir?
So this is, it says 10-year minus 3 months treasury.
Exactly. It's basically yield spread. By yield spread, what it basically says is it subtracts the longer duration interest rate with the shorter duration interest rates. That is the 10-year treasury constant maturity rate. For example, the yield on a 10-year bond is, say, for example, 5%. On the 3-month bond, say it is example 3%. So 5 minus 3 is supposed to be 2.
So it will always be on above 0 in that
above
sense.
0. What happens during the yield curve inversion? It comes below 0. That is, shorter duration bonds have a higher interest rate, and the longer duration bonds say have a lower interest rate. Right now, the yield, if you look at the right side of this, right now, this difference is minus 1.
Wow, it's never been this low before, it seems.
It's never been this. What happens here comes a very important thing. Yield curve inversion happens when this spread becomes 0. If you look at it, around 2022, this yield curve got inverted. That is, it came below 0. You could see now, sir.
Yes.
If you look at the graph, around 2022, this came to 0 and started plunging.
Right.
So what we have to do is, what people assume is, when 2022, when the yield curve gets inverted, that is a bad sign. That means now there's the panic among people's mind that there's going to be recession. But the markets play a different role. The actual recession happens when the yield curve disinverts.
Okay.
When the yield by disinverts, I'm what I'm trying to say is that it plunges and then starts coming up.
Right. Just like we are seeing in the graph.
And if you look at the same graph, if you see there are shades of gray marked in. Those shades of gray are actually periods of recession. The 2008 recession, the 2000 financial crisis, the 1991 crisis.
Hmm.
If you look at it, all the crisis happened when the yield curve disinverted.
Right. So it dropped down and then came back. So that is when the recession kicked in.
Came back, the recession actually happened. This is very important to note. Why? Because the yield curve inverts, recession will not happen actually.
Right.
So only when the yield curve disinverts that recession starts.
Right. Okay, so this is called the yield curve inversion.
This is called inversion. And this is one thing. I have taken another graph where it shows the 10-year and the 2-year difference.
Okay.
If you look at here also, if you look at it, it's got inverted and now it is trying to disinvert.
Right.
Look at earlier periods in 2008 also, same thing happened. Just before the recession, just before the 2008 banking crisis, it got inverted and then disinverted. In 2000 it has happened. In 1980s, you remember the oil crisis of 1980s? This has happened. So what we have to remember here is that when the yield curve inverts, that is not when the recession is going to happen. It's only an indication that there is a negative outlook on the economy, that there is going to be recession. And, professional players in the market position themselves accordingly. What happens is, but what the general retail thinks is when the yield curve inverts, they think that the recession is going to come. But that is not what actually happens. When the yield curve inverts, that is not when the actual recession happens. Only when the yield curve disinverts, recession happens. Or recession begins.
Okay.
So what we have to remember here is right now we are very close to such disinversion.
Right.
If you look at this graph, which compares the 10-year maturity with the 2-year maturity, and if you look at this graph, the 3-month 10-year treasury maturity rate, interest rates, they are both on the verge of disinversion.
Okay. So let's try to wrap this up, Vicky. What should we do?
Exactly.
What do you recommend for people?
I'll come to this interpretation. The interpretation I put it in here.
Yeah.
So how to interpret a yield curve is very simple. If it's a normal, then it says that national markets are healthy. Rates are normal. People are having a positive outlook. Healthy in financial markets. And in case of inversion, that is the shorter duration bonds, bond yields are higher than the longer duration bond yields. That means there is an expectation of a recession by the financial giants, by the financial players. And when the disinversion actually happens, the actual recession begins.
Okay.
Exceptions for this actually. 1 or 2 exceptions here and there, but most likely this is a scenario that will play out.
Right. Now, if this plays out as you are explaining it to us, what do you think people should do?
So, but thing is,
should we stay out of the market? Should we just, play it safe and stay out of the market?
My personal opinion take is that from what I've studied the earlier periods, this is how disinversion plays out. But
this is how it plays out. So,
this is how it plays out actually. When disinversion plays out, with the curve disinverts, definitely there is going to be a market-wide correction.
Correct.
Be it stock markets, be it Bitcoin or anywhere. Unless Bitcoin decouples, there is going to be a sharp correction across the markets.
Right.
So obviously, what happens? This is I'm telling it from what I studied in the past. So obviously, there will be huge correction when the curve disinverts.
Okay.
Second point. After the huge correction, there will again be a rise.
Of course.
Again, be a rise.
Okay.
And then it is going to be a proper recession. look at the yield spread. The yield spread pretty much says you, especially this yield spread that you're seeing on screen, the 3-month tenure, the yield spread, if the more the difference has gone down, the more worse it probably is going to be.
Okay. Right.
So in my case, I think that there is going to be a sharp correction in the beginning of 24, or right now, maybe starting early, like end of 2023 or the beginning of 2024. And then probably the next financial year, 2024, 2025, will be probably having a good rise in markets again, because election years in the US, as well as in India, probably this will have an effect. And once those elections are done, probably that marks the peak of the markets. Like, say, for example, I am personally expecting, I think 2025, 2026, 27, these years, you'll be seeing a proper recession.
Okay. Well, thanks a lot, Vicky. This has been an enlightening session for us. A lot of good information here.